Hey, good morning, everyone. Marty Mazzori here with your weekly macro update. I don't know if I'm getting lazy, but I think this is the third or fourth in a row that we're doing on the video. But once I'm done with it, I just kind of want to get to it and tell you what things look like, what our readings are telling us. And then I'm going to talk a little bit about markets and so forth. We could just do this all day. The dynamics, the cross currents out there, both from a macro perspective and then from a financial market perspective, are almost dizzying, quite frankly. And we are living certainly in unusual times, to put it mildly. And let me just start with telling you that this recession that we had last year, in terms of depth, it was the worst by far since the Great Depression. And while the NBER hasn't officially called the end of it, of course we're past the recession and we're back in expansion mode. And I did say back in expansion mode as opposed to a new expansion. Technically, this is a new expansion because we went through a contraction. And it's a new bull market in stocks because we had a bear market for 3 weeks. Pragmatically speaking, no. Certainly when it comes to stocks, you would call that a correction. Certainly from a time standpoint, it was 3 weeks and we bounced out of it. In terms of a bear market defined by a 20% decline, well, yeah, then we got a bear market. In terms of the economy, we had this incredible dip. Or did we? We certainly did in GDP for a moment. And we had incredible, tens of millions of jobs lost. But right away, we had incomes rising, retail sales rising. We had data in the midst of this horrific recession that went up. People got wealthier during the recession. Now, we know why, and I don't think I have it dialed up, or maybe I do. But the chart that I showed in this morning's note, just go there if you didn't have a chance. And I kind of talked about this morning's jobs number, which was fascinating and surprising. Made some comments and then said, I'll just leave you to your own impressions when you look at this chart. And it just showed how much personal income is a result of government transfers to people's bank accounts. That explains pretty much what needs to be explained about this really strange situation we find ourselves in. Explains somewhat, what you see right here in our index going up, above 40, which is amazing given where we were. And we have to ask ourselves the question, will government transfers like that go on ad infinitum? Stocks may like it to a point. The trees can only grow so far, so fast. But what does the other end of that look like? And that's something we're very sensitive to, and we're looking for indicators in terms of judging, time frames and consequences of when things, start looking a little more normal from at least I'll say it again, from a government transfer perspective. So, but the data is what it is, and you're looking at a PWA macro index that's looking very good and really accelerating to the upside. Okay, so we'll run through some key indicators. Not all of these changed. A couple things actually went the other direction, but truly a nice net positive in terms of indicators, positive versus indicators negative. Certainly nothing wrong with consumer sentiment right here. The Conference Board monthly number, as you can see, just really accelerating to the upside. University of Michigan's. Bloomberg's gives us their weekly comfort index. So yeah, a little bit of a, just a kind of a sideways to slightly down move on that survey. But the trend is very, very positive in terms of what the consumer thinks about his and her, short to mid-range future. Weekly jobless claims. This is where the today's jobs number begins to get really weird. We actually move this to the green. We're back below this threshold, and of course the trend is lower. So we were down below 500,000. In fact, it's that yellow one you can't see, 498,000 initial jobless claims, like the trend, continuing claims below this threshold line that I drew here a long time ago. And so that's positive. That says that people are going back to work. Job openings in the U.S., call it 7.4 million. That's historically high, as you can see. So lots and lots of places that are wanting to put people to work right in the here and now. ADP, the payroll company, their private employment report that comes out the Wednesday before the BLS jobs report, which came out this morning, 742,000 people found jobs over the last month. That's incredible, right? But that's what we expected. In fact, this morning's number was expected to be at 1 million. However, it came in at 266,000. That's got to be one of the worst misses by economists in history, no doubt about it. So literally, they expected 1 million new jobs, and 266,000 were created. And last month's were revised lower by like 100,000 or more jobs as well. So yeah, not what was expected. There was nothing in the jobless claims report this week, obviously nothing in the ADP report. I gave some of the detail in this morning's note. Fascinating. I didn't hear or see this interview. I just saw one comment on it. Fed Governor Neil Kashkari supposedly was doing like a victory lap with today's number because it supports the huge accommodation that he's one of the more dovish members of the Fed, wants to continue doing. That's suppression of interest rates and just money printing ad infinitum. I don't know. Again, I didn't see the interview, so I want to be fair to him. So let's say it were true. You don't want to be celebrating such a disappointing jobs number. But if you're a Fed governor and you are just hell-bent on not tightening credit conditions, monetary policy, not acknowledging the inflation that we're seeing everywhere, to have this number and have any credible professional economist or analyst say that this is anything but probably just a really weird anomaly probably speaks more to the fact that we're overly generous in terms of the, I don't know what else to call it, free money to consumers. Makes for good economic data, but it makes for amazing distortions, and this is one of them that we're seeing right here. And sure, we want the good economic data, but my oh my, what a hotbed of inflation risk that ultimately could be. Now, you could argue that, well, that's not going to last forever, and then we're going to get some deflation. And there's a longer-term structural narrative that I'm warm to, at least at the moment, that I've been sharing, and I'll probably share more of it as well. So I'm in the camp that says I think we're going to be sitting here, years from now, and we will have a different trend relative to inflation than we've had for the last few decades. And we're leaning toward that in our portfolio as well, and I'll explain more of that as we go here. Okay, so truck tonnage. This one, this surprised me again. These cross currents, strange data points. You'd expect truck tonnage to be going through the roof, and you can see it's dropped down here below this threshold. So that was actually a negative pull on our overall score. So again, and this is very volatile. And while rail traffic was rolling over, here it is taking off. And of course, there's a little difference in timing. The rail data comes out weekly. The truck tonnage that I just showed you came out monthly. So I guess it wouldn't surprise me if truck tonnage, came up and bounced nicely like rail traffic has. The global PMI, or Purchasing Managers Index, I think it was this week I shared with you some of the results from a few countries. It's a very nice move, 56.3 in the aggregate. These are the monthly surveys of purchasing managers among different industries, in this case both services and manufacturing. Above 50 month over month shows expansion, and you can see we've been accelerating nicely here the last couple of months. Citigroup's Economic Surprise Index for the U.S., it's still positive, but what this one measures is what the actual economic results are relative to what economists had previously forecast. So this is obviously a negative from a trend standpoint. Speaking of expectations, inflation expectations embedded in the spread between the TIP yield, Treasury inflation protected securities, and the actual nominal yield on regular Treasury bonds. So this essentially, or you could call it inflation compensation. One thing that was interesting here is that the white line is the 10-year inflation compensation, or I'll say expectations. That's how most people look at it. It actually has ticked up here very recently. I don't know how well this is going to show up on the video, but on On the 5-year and on the 2-year basis, they actually rolled over just a little bit. So the economists who are not sympathetic to our inflation view would say, look, you see how short-term inflation expectations are rising. The 2 and 5 are rising above the 10-year inflation expectations, whereas here the 10-year was higher. So that suggests that people expect further out for inflation to come down and say, well, okay, it's still 2.5%. And that actually makes some sense. You should expect on the near term, with all the bottlenecks and everything else, for inflation to accelerate. And then I expect it to settle down at a rate that's higher than what we've been used to for the last, couple, 2-3 decades, actually. How about those commodities? I've been doing a little technical analysis with you folks here lately, and the bull flag pattern is one again where you have clearly this is a very classic looking bull flag. Technicians would take the length of the flagpole, right? Place it on the breakout, and that would be your price target somewhere up in here. So far, so good. It looks like that's playing out. That is too steep a trajectory. Commodities are going to correct any day now, I can almost assure you. Long term, if we're right on our inflation thesis, this will really help our portfolios. In fact, the last month, our core mix has outperformed just about every equity index. And again, I preach that we do not want to live by that standard, particularly if you're a macro firm like we are, where you can go virtually anywhere to satisfy your thesis and protect your clients and look for growth and so forth. Right now, our core portfolio is just barely over 50% stocks. The rest is commodities, very short-term corporate bonds and cash. So the commodities now coming back to life here is helping our relative performance. Singling out copper, looks like the bull flag pattern is about run its course, right? Just about, maybe a little bit more left in it. We're at like a 2011 high, just actually piercing through that. 2011, if you'll recall, was back when people were robbing light posts for the copper. Very different dynamic now. Back then, you also had copper miners just exploding in terms of capacity, meaning borrowing money and building out their mining capacity, hiring people, and so on and so forth to accommodate China's thirst and need for copper. Utterly not the case today. This is similar pricing against real capacity constraints or very, very slowly growing capacity. So the mining space and the miners that we have in our core portfolio, I am very optimistic on over the next few years. I think profitability is going to be huge for those companies. And the price of copper, which we're in with our base metals ETF, doesn't need to keep going up and go to 15, 20,000, although it very well could. But again, this is just an unsustainable move. So I fully expect that commodities come back down, but what we're doing is investing, with a long-term thesis and then pounding on that thesis day in and day out along the way. So right now there's definitely fundamental reasons for copper to continue on this trend, but I would sure like to see us get some corrective action in here and maybe even form maybe the next bull flag pattern. That's what's been happening. As you can see, we just kind of keep flagging up, right? Moving up, consolidating, moving up, consolidating, moving up, consolidating. We're due for a consolidation right here. And last but not least, I just can't help but show you each week the Baltic Dry Index cost of transporting bulk across the world's oceans. Unfathomable. It's really due more about problems in terms of delivery capacity or shipping capacity right now. It is global growth. There's no doubt about it. I mean, manufacturers are pushing it to the hilt. I talked about the Japanese steel company this morning. 4 times expected earnings were announced last night. So yeah, we're getting massive growth. There's no doubt coming out of COVID, but we're also paying for it. And make no mistake, if anybody who would tell you those Neil Kashkari with the Fed or anybody else who would say that's not getting passed on to consumers is out of their minds, or they're really trying to paint a picture that's just very much at odds with reality. So also I wanted to just kind of run through these charts that I featured in this week's written main message. First one here came from John Hussman, and he just talks about here that investors seem to be underestimating the extent to which an economic rebound will replace rather than augment the effect of trillions of dollars in pandemic relief programs. So this is so true. What we've experienced, these anomalies with this current situation, last year's recession, so on, has everything to do with trillions of dollars being pumped into the economy, right? Particularly in asset prices. I think I said this yesterday. When you literally create excess liquidity, and this is not just the U.S. central bank, it's virtually every central bank. Excess liquidity means that's more than your economy really needed to stay afloat. And you've suppressed interest rates that just kill savers. Just no incentive to save money by traditional safe means. You are just forcing them out onto the risk curve and literally trying to send a message that there's no risk out there on that risk curve. I couldn't think of a riskier scenario in the grander scheme of things. Inflation expectations mean a lot, and they should mean a lot to the Fed. When they're low, they say they mean a lot to them. When they're high, they seem to not talk about them as much. But 87% of Americans are either very concerned or somewhat concerned about inflation. They see it, and they think it could continue. B of A's private clients, kind of their elite clients, are more in stocks, the last reporting, than they have ever been. We're in the midst of Q1 earnings reports, and the mentions of inflation triple the norm. So companies are talking about inflation and what that's doing to them and what they're having to do to their customers as a result. Margin debt, borrowing money to buy stocks, is at an all-time high. So folks, when I say all-time high and I show you a chart, what you really want to do is go back and look at when it was high before and when was that, right? Well, that was 2018, and we had two corrections in 2018. One was 10%, one was 19.8%. And then here was the peak in 2015. 2015 and 16, two corrections that totaled a 16% decline in stocks. And again, this is just the amount of margin debt. And the peak, here back in 2010, this should go back further. There's a chart that comes up here somewhere for the 1999 scenario. So this is where we are currently, which is higher than we've ever been. American households, like B of A's private clients, have more money in stocks than they've ever had before. Last time they had this much money in stocks was right before the tech bubble burst. Before that was right before the huge bear market in 73 and 74. So here it is now. So if anybody questions why we think we should spend a little money hedging portfolios with options, this is evidence as to why we think we should do that. This is that one I just talked about earlier, the parabolic spike in government payments as a percent of personal income is higher than it's ever been, 34% in March. And we just gave you March jobs numbers, or the BLS did this morning, and it was tremendously disappointing. Does this have something to do with it? You tell me. So what would the market do if we raise corporate taxes? And while they're making that case, is there a case internationally for raising corporate taxes? Well, according to the OECD, there is. This is the U.S. Corporate tax rate for 2018 versus the rest of the world. So expect charts like that being thrown around by certain politicians when they want to propose corporate tax increases. And then you got to ask how the equity market's going to respond to something like that. Back to inflation, the Institute for Supply Management Prices Paid Index. We're just about as high as we've ever been. Got to go back here to just before the big disaster in 2008 in terms of the market. We talk about buy the dip. Everybody's buying the dip. Corporate insiders, the red line, are corporate insiders selling their own stock. The blue line is them buying their own stock. So corporate insiders, as I say here, are selling their own company stocks on rallies more so than they're buying the dip. So retail investors seem to be running in and buying every dip. Corporate insiders who own a lot of their own stocks seem to be taking more advantage of the rallies to get out than the dips to get in. So interesting dynamic there. So folks, there is so much more I could throw at you. I've got more things dialed up, but we're pushing a half hour now. I'm going to edit it down a little bit, and I'll leave it there, and I'll just keep coming at you at least once a day on the blog. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Bye-bye.